guys, welcome back. My name's Arnav.
And my name is Gaurav. And welcome back to Wall Street on Westheimer. The date is August 10th, 2022, and the time is currently 3:30 p.m.
So recently we've had some pretty unique changes in the ETFs than what we predicted last meeting. So the S&P 500 right now is at 4.2K today right now at up 2% for the day.
Mm-hmm.
The Dow is up 1.63% and the Nasdaq is up 2.89%.
Mm-hmm. And since the last meeting, the S&P is up 8% over the last month, the Dow is up 6.3%, and the Nasdaq is up 10.4%.
So I think the first thing we should talk about is we haven't, since it's been a month since our last meeting, and we predicted that the S&P and like all these other ETFs would go down, and it's quite literally done the opposite. So what I think our mistake was in making that prediction was we accounted for the stock market to follow economic rule. So whatever the economy would do, the stock market would follow. But that's what I thought, and that's what any normal investor with little experience would think with dealing with economic recession. But looking over the past years, past times there's been recessions, the economy has usually not moved as much as the stock market. The stock market moves on average to 9 to 8% every year, but the economy usually stays the same year to year. So I didn't really know about this, and I just assumed that the economy would be a telltale sign of how the stock market moves. So what about you, Gaurav?
No, I fell into the same trap, actually. So, like Arnav said, with the economy going down, inflation increasing, a lot of companies, we were expecting their earning reports to be a lot less than they were. So we kind of fell into the same trap. And I guess that's a sign of being an investor, right? Every investor learns from their mistakes, and that's what we're doing now. So we used to think that the stock market would follow economic growth, and now we know that they're separate things, but you should still look at the signs of economic growth in your evaluation.
Just because the economy is in a recession does not mean the stock market is also going to follow into a bear market. So now we can go over to earnings reports. So not all companies have released earnings reports because each one has their own set date for quarters. So major companies that showed increase in revenue have been Amazon, Apple, Microsoft, and PayPal. All four of these companies have showed good sign of revenue in their financials.
Mm-hmm. And while you might think those major companies are up in revenue, might signify that the entire market is up, it is not. So on the other hand, you have major companies showing a decrease in revenue in their earnings reports, like Meta, Intel specifically was drastically down. Lockheed Martin reported losses, and Target and Walmart did not reach the analyst expectations.
So, something I'd also like to discuss about earnings reports are energy companies like oil and gas, Exxon, Oxy, Chevron. They all reported record-breaking earnings, and I actually did a stock pitch and a bunch of analysis on Oxy, and by doing that I learned a lot of what's going on right now in the market for oil and gas companies. So they all three of the ones that I mentioned recorded record-breaking profits, and this is simply because oil and gas was the highest this past quarter that it's basically ever been. In my 17 years of living, it's never been that high. I don't know about before, but yeah. But it's the highest it's ever been, and obviously sales is based on price and quantity, and because people are traveling more because of COVID, whether it be COVID or something else, people are traveling more, which requires more energy, which causes quantity to go up, and then price also went up. So there's the two things that determine whether revenue will go up for oil and gas companies, both went up. So that's going to cause exponential growth for energy companies, which made them see their stock price jump up quite a bit. So that's just a small spiel on oil and gas companies this past quarter over their earnings reports.
No, yeah, everything seemed to go really good for these oil and gas companies. First of all, this quarter is the summer quarter, so everyone was traveling. Then you have COVID, inflation, You still have Russia on their oil embargo. So all of these caused the oil price to go up, so their profits, like profit margins and actual price and quantity, as Arnav said, they both went up exponentially, which led to these insane revenue.
Mm-hmm. Yeah. So if I remember correctly, Oxy like had 4.2 billion in free cash flow. Their quarter to quarter, year to year operating cash flow, everything, sales were up, everything was up basically for that company, and it actually, when they released their earnings, they actually dropped 5 points, even though they had record breaking sales, which just shows how much they were actually predicted to earn. They, even though they like made, even though they cut down their debt like by like 25% and like made all these like revenue jumps, they still were expected to do more, which just shows how much like the oil and gas market was predicted to make over this quarter. So high expectations, and even though like some fell short, they still made good strides on their company.
Mm. So knowing all of these earnings reports, it really leads us to the question of, are we still fearing a recession, right? So in our last meeting, we talked about how there was going to be a Fed meeting on July 27th, I believe. Yeah, July 26th and 27th. And so they were choosing between a basis point hike of either 50, 75, or 100. That ended up going with a 75 basis point hike. And at that meeting, it was very significant because they also said that the odds of raising the interest rates at the next meeting were very unlikely.
So, last time we met, we said odds of raising it again. Yeah, we were unlikely, but I think they did it again because we discussed this in a previous episode. But people were still going out to eat. People were still going out to travel. People are still going out to buy shopping, go to shopping, go malls. They were doing everything they would have done without the 75 basis point hike prior to this one, this most recent one. So they obviously needed to hike it up more so they can reduce inflation, because if people keep going out and spending, inflation is going to continue, which is bad for the economy. And that's the opposite of what they actually need to do. So they needed to increase it more, and in hopes of people going out less and buying more stuff. So let's see. I mean, it's pretty recent, not that long ago, like 2 weeks. Yeah, 2 weeks that they did it. We still need to view ourselves how much it has affected the market. But what do you think? Do you think more people are going to go out, less people are going to out, same people are going to go out?
I think less people are definitely going to go out. We're going to get into this later, but the inflation rates came in for today, and it showed a significant decrease in inflation in my eyes. So I definitely feel like that's going to reflect on consumer sentiment, and so I feel like a lot less people are going to start going out and buying.
Yeah. So, if inflation is decreasing, I don't really see a point of there being another BP hike again, or they're most likely going to keep it the same or reduce it a few. But if inflation is dropping, that's exactly what they want it to be. So I don't think we'll see another one.
So actually today the CPI data came in, and so as a nation we're currently at an inflation rate of 8.5%, and so this was actually surpassing, like when I say surpassing expectations, I mean it was lower than what we were expecting. So it was actually stated that if inflation was at 9.4% or above, the Fed was actually going to take their word back and increase the basis points by a 100 basis point hike. However, thankfully, we did not reach that 9.4% threshold. And so since we're sitting at a pleasant 8.5%, we're most likely going to see the Fed following through with what they said at the last meeting and not raise the interest rates again.
Okay, so due to the stock market, due to like everything else going on right now, the odds of further recession have heavily decreased, and as Gaurav mentioned before, just now, that inflation fighting tactics have worked, that the Fed have been employing through the basis point hikes, and because of that, the recession is odds of a recession continuing. We're in a recession right now technically, because the 2 quarters have been decreasing, but odds of it continuing are very unlikely.
Yeah, but that definitely doesn't count out that there's still a chance of the recession continuing. So there are many things that could still signify that, right? So we did see that some companies did report an earnings loss. So like the earnings reports were definitely neutral around the nation, right? So it's some sectors doing good, some still doing bad. Um, and many of these company valuations still show high signs of overvaluation, like PayPal, for example. Their stock started booming after they saw a great increase in earnings, right? But if you look at the actual value evaluation, like value investing evaluation of it, you'll definitely see that it's still heavily overpriced.
Yeah. So, like I mentioned before, like energy companies that were doing extremely well, right? And I valued Oxy and through like a financial modeling process, and even though it's been doing extremely well, it still says it's properly priced. Like I did the DCF model and it said 58.2 and that day it was at 58.5 after reporting their earnings. So even though these companies are doing extremely well, many of them are doing still properly valued or very overvalued.
Mm-hmm.
So that's that's a trend that has been continuing over the past few years as well, as companies have been extremely overvalued, like Tesla, Amazon. Like their prices have been way too high, but the market has still been trending up, and we've seen that trend break like recently, which is why we're kind of adjusting.
Mm-hmm. And another new term that started going around on the news. It's called boomflation. So the term you're most likely familiar with is stagflation, where the economy stays stagnant and inflation continues to rise. However, in this new term, boomflation, we're seeing economic growth increasing, but it's increasing at a reduced rate, and inflation continues to increase, which is still a sign of recession. And this is really predominant in China, where China is currently in a recession, and they're going through what we see or what we call as boomflation.
So, what do you mean by boomflation? Like 1 year it had 10%, then the next year their growth was 8%, then 6%. Like it's slowly decreasing, but at the same time it's decreasing year to year, but at the same time overall it's increasing.
Yeah.
So that's what boomflation means.
Mm-hmm.
So, okay, yeah, just making sure. And then, what about macroeconomics? Like,
Right. So if you look at the candle charts for like the day by day, for the year and quarter, you'll notice that the patterns are very similar to the 2001 .com crash, where you saw this like small relief, which you could say we're experiencing right now, and then it'll later be followed up by another crash. However, this is just following the patterns that we saw in the past, and I don't know, because the current situation is very different from the other ones we've dealt with. It could be like a completely different type of recession. You can't really predict the stock market, but just looking and comparing to the past patterns, you'll notice a lot of similarities with the 2001 crash.
yeah, but in my opinion, I don't think it's a good idea to compare past charts to the present charts, because I don't really think uh, every situation is different,
Mm-hmm.
and
Yeah.
obviously there's not a .com crash happening. There's a different type of recession happening right now,
Mm-hmm.
and that's not what happened in 2001. So I don't really think you should follow past charts to determine future charts. Like I don't think that's a good way to analyze the market or the economy. That's my opinion on that.
Mm-hmm. I mean, yeah, you could. They're definitely completely different situations, but I guess if you wanted to like kind of compare, like evaluate completely off of candle charts, you'll see that it has some similarities. You can't completely rule out the possibility of the recession continuing.
Yeah. So right now, current relief could be seen as a short rise followed by another crash. So noting that, we can go ahead and go into the structural support of how the real estate bubble is fragile right now, and the entire market being supported by companies buying all the houses. So I can talk about the real estate bubble right now, but I'm not really sure about how companies are buying all the houses right now. So can you cover that after I discuss?
Yeah, yeah.
Okay, so what I know about the real estate bubble right now is that mortgage rates are still high from the first episode that we had where they increased it, and so because they're still high, it's just you're having to pay double the amount of what you're actually paying for through mortgage loans. So if you buy a 800K house right now, over the course of your I believe 30-year mortgage, you will pay 1.6 million. So that's just the way amortization is working right now, and it's just causing. So technically, the house prices like face value are decreasing, like how 1 million like how 700K houses used to be 1 million a couple months ago, and now they're like 900K. There's actually you're having to pay more at that 900K price than you did at that 1 million price, even though 1 million is higher, because at 1 million the mortgage rates were lower. So over the course of 30 years, you would have to pay less as there was less interest going onto that loan. But now it's at 900K and the interest rate is even higher because of the Fed and like and the mortgage rates increasing nationwide and statewide in Texas. So you're going to have to pay more for 900K than 1 million. So it's kind of like a trick to get you in. And the banks are kind of profiting, not even like the people selling the house, because the people selling the house are selling at 900K as opposed to 1 million, but they're forced to because the market is trending downwards, so they're not going to be able to sell their house if it was at 1 million. So the people profiting off of this are like the banks issuing the mortgage loans. So that's what's happening right now in the real estate bubble right now.
Mm-hmm. And so what I meant by the companies buying all the houses, I was referring to how, like, in the past meetings we were talking about how Goldman Sachs was going through and buying a lot of real estate, right? So a lot of people have been, like, selling their houses recently because of what we said, the mortgage rates. So it's more expensive for them to hold these loans and continue owning these houses. So that's where these companies are swooping in. They're holding a lot of real estate, which is preventing from the entire real estate bubble to maintain itself. But it's really fragile because we're entirely dependent on these companies holding onto these houses.
Okay, so that covers real estate, and now we're getting to gas prices. So as of August 8th, the national average price per gallon for gas was only about 4.059, which is a pretty big drop. At one point, I believe it was over 5.
Yeah, it was definitely over 5. I want to say close to 2 months ago, maybe even 1 month. Maybe. I'm not exactly sure. Mm-hmm. But I'm looking back on the last meeting notes. That day, the gas prices dropped 3.1 cents overnight per gallon. And so clearly we're seeing a trend of gas prices falling back down, which is a good sign that inflation is decreasing. You can also expect a lot of these oil and gas companies to start performing less than the current quarter, because as we did say, there were record-breaking record-breaking earnings this quarter, sorry. And so we can definitely expect those earnings to start to decrease back to what we see as normal.
Okay, so yeah, following that continuous drop, I'd like to get into talking about the Metaverse, because I don't believe we've talked about this in the past 2 episodes, so now would be a good time to bring it up. So my thoughts on the Metaverse is it's a new technology. It's part of a new wave, Web 3, and we're currently on Web 2. These are just acronyms for like generations of the internet. So internet was Web 2. Like everything we're using right now is Web 2, and Web 3 is going to be like the Metaverse, like virtual reality, going through like basically living like another life through through online. Yeah. Mm-hmm. That's what the Metaverse is, and it's part of the Web 3 takeover. So my thoughts on the Metaverse include that I am personally wouldn't like it because it's not actual reality. But then again, people, when the internet came out, especially older people in the 30s and later, were opposed to taking the internet. They thought how the internet even make money, and then advertising came along, and then people actually started making money from the internet, and people started using it more, and that just removed that whole argument of the internet not being able to work. And now it's something that everyone, or basically everyone, almost everyone needs on a day-to-day basis. So that just shows like I think it's better to hop on the train of something new, like the metaverse, than get left behind. So that's what I think.
My take on the metaverse is, I mean, there's a lot of things that could go wrong with the metaverse, right? I'm sure many of us have seen like the movie Ready Player One. Like, it creates the metaverse creates a lot of opportunities for corporate like possibilities, right? But there comes many other concerns like who's going to be able to control it. It's going to be what's the term I'm looking for? Um, you can't really control your privacy on the metaverse. It's going to be difficult, as well as whoever is running the metaverse, right? So you're gonna obviously need to go to the metaverse through consoles, which currently the leading producer of virtual reality devices would be Meta, or like what used to be Facebook. So it's gonna be a lot of like privacy issues that you're gonna have to go through, and it's gonna be a really big hassle. But I feel like when it does come out and all of these do get sorted out like through legal action, the metaverse will definitely be successful and a new opportunity for everyone.
Okay, so what about NFTs? I like. I guess there's value in them, but like there's no intrinsic value.
Mm-hmm.
So the only point I see of NFTs is like just trading them for it, like just for money, for an extra money grab. That's all I believe NFTs are.
Yeah, the hype behind NFTs have drastically declined lately, especially with the crypto drop. NFTs have really lost their valuation. However, some of the NFTs, like the popular ones like Bored Ape Yacht Club, a lot of those have actual like in real life values because they invite you to groups, they get you connections, they offer perks with certain corporations, and then you have the other NFTs that offer services within the metaverse when it like does come out. So like some NFTs offer houses in the metaverse and other things. So I don't know. NFTs might have a future, but currently they're in a like steep decline because the hype around them have definitely died out.
Okay. And then, on a side note, Bitcoin and other cryptos are over the past month going back up. I believe Bitcoin's at 28K now, after a steep drop from, at one point was 70K, in 2021 or something. Yeah, like late 2021 or mid. It was at 70K, and now it's at hit like around 20K, and now it's going up like 28K. So watch out for that. It's back on the way up, and we'll continue to see how that follows through. And now we're gonna get into this new section where we have possible buys. Obviously, we're not financial advisors, so do your own due diligence. We're just 17-year-olds in a house that is paid for. So, so Cara, you want to start it off?
Yeah, so a few possible buys that I was looking at were including pharmaceuticals, so like Pfizer, Johnson & Johnson. I personally like this one pharmaceutical called Viru. So the reason I suggest these buys is because with the federal announcement making monkeypox a new nationwide epidemic, right? So it's going to have spur up demand for the creation of vaccines, medicine to prevent monkeypox. So it really brings like a lot more demand to the pharmaceutical scene, giving rise to more investors investing in these companies.
So what about AMD and Nvidia?
Right. So as we said, crypto is really like declined, right? And crypto's starting to go back up. But with crypto just recently, like a month ago, hitting their bottom peak, right? Or like relative bottom peak, because we don't know if it's going to continue declining. With that bottom, right? So a lot of the hype for graphics cards suddenly declined because crypto is now like valued at a lesser cost. So people had less reason to buy these cards, making the price of these graphics cards fall back down. But as crypto goes back up, you're gonna see the demand for these graphics cards rise with it, right? So currently, if you buy into these companies, like in my opinion, if you buy into these companies, when crypto goes back up, you're gonna see these companies' stock valuation rise with it, as there's a higher demand for these graphics cards again.
Okay, so a buy that I had were I bonds, and I know bonds are not as nice looking as stocks, but this bond is something that I think everyone needs to take a look at. So I I heard about it through my dad first of all, and then I went to Warden, and then the professor also mentioned it there. So I was like, I might as well just look at it at that point, right? If someone my dad is telling me, right? My dad's like, okay, yeah, some normal investor, but then a professor tells me to look at it, like two people, yeah, within like 2 day span, yeah, I should probably look at it. So I bonds are interest rate bonds that are government issued, and bonds are basically loans that you issue to the government, and they pay you back in interest based on whatever specific type of bond you buy. So these ones are called I bonds. I stands for interest, and right now they're around 9.76% interest rate. So, so if you buy it right now, you're guaranteed a 9.76 interest rate at least for the next 6 months, because bonds are semi-annual paid back. So, and it is worth noting that every person can only put max 10K using the government website for securities and investments. And so if you have 5 people in your family, you can put in 50K, and that 50K, almost 10%. So that's almost, yeah, that is almost 5K back. So, and these interest rates vary. So right now it's at 9.76, but it won't obviously drop down all the way down to 3%. It will like fluctuate in between. So if you buy right now there's almost a 10% increase, which is guaranteed, as the government can't default back. So that's just some guaranteed money I'd like to share with all of y'all. So that concludes our third episode of Wall Street on Westheimer, and thank you guys for listening.
Yep, thank you, and we will see you next time.